Stocks rise a fourth day, bond yields fall a fifth, and Bitcoin poking back above 71,000. Live from Studio One here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Scarlett Fu. We're kicking you off to the closing bell here in the U.S. Let's get a check on where markets stand right now. The S&P 500 currently poised for its 25th record high of this year. So yes, it is back at record levels once again. But you take a look at what's really driving some of the advance, and it's the Nasdaq 100, up 1.8% as a group. But within the Magnificent Seven, that's where the real gains are showing up. Treasuries started the day kind of little change, but they've since moved higher. The two-year yield, 4.72%. We've got the FOMC meeting next week, of course. And paying attention to the loonie because the Bank of Canada has cut rates and signals it is reasonable to expect further rate cuts as well. Romaine?
All right, well, going back to the U.S. market, record highs on the S&P and the Nasdaq, and kind of telling that the intraday low today came right at 9:59 a.m. New York time, which was just 1 minute before the ISM released that data showing the U.S. services sector returning to expansion. That was powered by the largest monthly gain in business activity going all the way back to 2021. Chip stocks set for their best day in 3 months, and the Mag 7 as a group perched right now at fresh record high, with most of the risk-on appetite clearly seeded by that 10 a.m. ISM report. You also saw that embrace of risk sentiment reflected in the 10 a.m. spike in Bitcoin, the 10 a.m. plunge in the VIX, and the massive volatility in the Treasury space during that same hour. Take a closer look here at the intraday move on Treasuries, and you're going to see that push and pull of bond traders really looking for reason to tilt dovish. That would seem counterintuitive given the hot ISM reading, but other numbers in that report, including moderation in input costs and a further slowdown in hiring, provide data-dependent arguments, for the Fed to cut rates sooner rather than later. You put it all together and voila, you got the risk on buy. But anytime that market gets collectively happy, Scarlett, there's always someone standing by with a data point to marsh everyone's mellow.
So I'm going to be the buzzkill today, at least for the stock market bulls. According to the Bloomberg Intelligence Market Pulse Index, which we have here, sentiment in May was so risk-on that it actually approached a manic state. If you look at the y-axis, 1 represents extreme mania, 0 shows extreme panic. And you can see that we're in the upper band right now. And this is a contrarian indicator. So when the index climbs above this top red dotted line of 0.75, that means there will be some mean reversion activity in stocks over the next 3 months. And in this case, perhaps slower gains or maybe even a decline.
All right, as we kick you off to the close, let's get right to it. Dan Greenhaus joining us right now, Solus Alternative Asset Mgmt Chief Economist and Strategist. And Scarlett there, walking right there in the background. We love it. Don't worry, Scarlett. We're going to give you a hard time for that. I will only mention that at least 6 more times during the show today. But nevertheless, we try here. Dan, great to have you here. You turned around and you looked at that chart that Scarlett showed. When you look at that chart there, I mean, what's your reaction to that?
Yeah, listen, we were talking off air that I felt like the next month or two was probably gun to the head, more likely to trade sideways or down a little bit rather than continue to make new highs for a variety of reasons. And the Market Pulse Index, which we have up on the screen right now, plays into that idea. But at the same time, I think the larger question for investors is this the end, so to speak? Is this some blow off top and we're now going to start moving lower in a more sustained and damaging fashion? And I don't think that's the case.
Give me the case, though, for further gains. Is it more just technical and momentum-driven factors? Is it fundamental? Or is it still about the elephant in the room, which is the Fed and interest rates?
Well, it's hard to ignore the technical and the momentum factor at play here. There's no doubt about that. Mm-hmm. A few stocks are doing a lot of the work here, driving the market higher, both for fundamental and technical reasons, and that's likely to continue over the next couple of months. But at the same time, you have a positive backdrop. The economy continues to expand, albeit at a slower rate, which is good because it plays into the idea that at some point over the next 9-12 months, the Fed will feel a little more comfortable talking again about reducing interest rates, if not actually doing so. And all of that, assuming the economy continues to expand and profits grow. And to be clear, earnings expectations have been going up for the next 4-6 quarters, not down. Then the bias for equities in that type of environment is probably to the upside, although admittedly that's built on a foundation here, again, where over the next 1 or 2 months, maybe we correct 3, 5, 6%, something like that.
How do you fold in things like meme stocks, like GameStop, like AMC, or the crypto miners or crypto tide companies that seem to get a boost every time Bitcoin gets into that $70,000 range? given the fundamentals? Or maybe there is no fundamentals to speak of when you look at that group of equities.
Yeah, I pay no mind to the fundamentals. Well, hold on. We're involved in a little bit of what we're talking about, so I want to be careful here. But as a general rule, those meme stocks aren't trading on fundamentals. They're trading on Reddit mentions. I checked earlier because someone had asked me about it. I'm not even sure there's more than one or two analysts on the street that follow GameStop from a fundamental standpoint, which doesn't mean it's not a valid company, which doesn't mean there isn't money to be made. It just means on the institutional side of things where I live, it's just not of particular interest. It's not important to the index. I don't know many managers that are involved in the space, particularly as it relates to some of the short covering that may need to be done if something goes on again. So I don't pay too much attention to them. Now, at the same time, is it emblematic of a risk on, game on type environment? Yeah, I think so. But I don't know that it tells me anything beyond that investors feel comfortable putting money to work in riskier names. Yeah, I like to be aware of that. But at the end of the day, we're a fundamental shop and we pay attention to the fundamentals.
I just want to point out, Scarlett, there are actually 3 analysts on the Bloomberg terminal that cover GameStop.
There you
and
go.
2 of them don't even have a rating on it.
Well, there you go.
So
there you go.
Well, I mean, it's an input into that mania that we were talking about earlier. So when you back up a little bit and you look at equities relative to treasuries, a lot of people are saying this is going to be it for treasuries. We're going to start seeing things take off here. How are you evaluating the relative value here?
Well, listen, equities, fixed income, particularly treasuries, have been a really powerful absorbent of capital over the last 12, 18 months. Now, we're a hedge fund. Institutional investors probably not going to be satiated by 4 to 5% returns. We're an absolute return vehicle. We're looking for returns exponentially larger than that. But for a large majority of the investment community, 5% risk-free does a lot of your work. If you think that your return is going to be somewhere around the market average, call it 7 or 8% for the S&P over the long term, you can get 5 of that 7% in a risk-free fashion for at least 2 years, if not at some points over the last couple of months for 10 years.
I do want to, sorry, just to cut you off here.
Please.
I do want to ask you a question here about the broader tech rally. We're getting a headline crossing the wire right now. This on Nvidia, the rally there continues with the shares up 5% on the day. And now, at least in the intraday here, at the $3 trillion market cap level, only the 3rd company in U.S. stock history to ever reach that mark here. And it gets to a broader question about crowded trades here. The idea that anytime we see these rallies, the strong rallies, it does seem like everyone is gravitating back to the Nvidias and the Microsofts of the world, because that's where at least some modicum of safety, at least the perception of safety is.
Yeah, so to be clear, I mean, we pay a lot of attention to these names because they're the AI trade. But at the same time, let's be clear. Revenues, net income, EPS, all grow exponentially larger for these names, not Tesla, but the other, let's call it 5, grow exponentially larger for these names than do the rest of the market. And in the case of something like Google, and to be clear, Solus is not a particularly large tech investor. We don't own any of these names as far as I know, and I should know, these names, they grow exponentially larger. They provide you safety in the sense that they appear to continue to be doing so. They're not as interest rate sensitive as perhaps the rest of the market. But at the same time, these are really powerful names from a momentum standpoint. I don't know how you don't own them if your goal is to outperform the index. At a minimum, you have to be market weight, but you probably have to be overweight by 100 basis points or something. If, again, your goal is to at least meet the index, I don't know how you would do it if you weren't allocated to these names. So it draws money in constantly as they continue to do better and better.
All right, Dan, got to leave it there. Dan Greenhaus over at Solus Alternative Asset Mgmt here on a record-setting day for the S&P and NASDAQ, powered ostensibly here by Nvidia. Nvidia shares up more than 4% here on the day and crossing that $3 trillion threshold. If it closes at that market cap level, it will be only the 3rd company in history to reach that level. That includes Apple, which has a $3 trillion market cap, and Microsoft, which has a $3.1 trillion market cap. All right, coming up, we're going to take a look at a company that has a much smaller market cap but is in the news today, Dollar Tree, posting another quarter of slumping sales and now reevaluating that monster acquisition of Family Dollar that it made just a decade ago as a spinoff. The key to a turnaround, some perspective from the sell side up next.
Plus, they say everything's bigger in Texas, but does that include equities? The state has big plans for a new stock exchange that is meant to grab business away from the New York Stock Exchange and NASDAQ.
And here on this record-setting day, as we count you down to the close, we're going to get some insights out of Steve Sosnick, Chief Strategist over at Interactive Brokers. Stick around. A lot coming up right here on The Close on Bloomberg.
It's Jobs Day, and Bloomberg has the report under surveillance.
We are seeing the labor market come into better balance.
That foundation for the economy is solid.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
This is not a labor market that's slowing down or grinding to a halt.
That's why everyone is looking at wages.
Payrolls report, 8:30 Eastern Time.
The May Jobs Report, Friday on Bloomberg.
It is official. Nvidia has become the third stock ever to reach $3 trillion in market cap. And it happens as Nvidia and the other big tech names rally today on the back of excitement over its AI business. Of course, Nvidia really the poster child for all this AI excitement because it makes the chips that power all that AI software. So joining us now is Bloomberg's Caroline Hyde, who has been, of course, keeping track of all these moves. And the question here for Nvidia is whether fundamentally, these gains are justified.
That is the key question. And for most analysts out there, they'd say yes. If you look at the ultimate amount of still buyers on the rating of the stock, the valuation in many ways is phenomenal from a $3 trillion perspective. But the PE ratios, they ain't that crazy. Because why? Revenue is growing at such a pace. Just take their previous quarter numbers. When you've got revenue climbing at 200%, no wonder the share price is already climbing 200%. We're meant to be anticipating these sorts of gains. It's meant to be a future indication of value. And ultimately, at the moment, many feel that, yes, it's an equivalent to an Apple right now in terms of market cap. It should be.
Actually, as Nvidia continues to move higher, it is now overtaken Apple. Of course, this is a parlor game. We have to wait till we get to the actual closing bell for this to be official here. But it really does sort of show how much has changed. Because remember, Apple was the big growth stock a few years ago. And now some people would say it's just basically just a cash generating dividend stock.
Value remains value.
Oh, sorry, value, excuse me. But Nvidia is the growth stock, right? Now, whether they actually make good on all those growth expectations, that remains to be seen over the long term. But at least for right now, this is where it's at. Is there anything else out there?
Well, in terms of comparable, where else you could, well, HPE today was showing that AI can bathe glory on some of the other infrastructure players. So if you want to be buying into future server demand, well, HPE see an 11% increase in its stock today and a new record high, but it is well off the market cap of an Nvidia. Now, remember, come Monday, we get a stock split.
Yeah.
This has got so expensive. Maybe some of that valuation has been picking up because we anticipate retail investors are getting more into the stock.
Well, that's what I'm curious whether that's probably driving this as well. And what does that mean? That Monday's going to be a dud? Is all this going to be priced in by the time we get there?
Isn't that what the market's meant to do?
Caroline Hyde, of course, you can check her out as the co-host of Bloomberg Technology. A closer look here as Nvidia continues to power higher, now up more than 5% on the day, and now eclipsing Apple in market cap. We'll keep an eye on that stock, but we want to move, I guess, to the other end of the market cap spectrum here and take a closer look at Dollar Tree. Those shares on the back foot after its quarterly report didn't live up to expectations. And now a lot of discussion here about whether the company should sell off its Family Dollar business. The company acknowledging that it is considering strategic alternatives here for that asset, an asset that it just acquired less than 10 years ago. Anthony Chukumba joining us right now, senior research analyst at Loop Capital Markets. He still has a buy rating on Dollar Tree shares. And Anthony, I want to go back to 2014 when the rumors started circling that Family Dollar was in play by Dollar Tree. There were a lot of people that questioned whether this was a good acquisition for them, whether they were paying too much. And now, with the benefit of hindsight, do you think it was?
Oh, there's no question about that. I mean, look, hindsight's obviously 2020, but I was writing back in 2016, I believe, for the first time that they should sell Family Dollar. It just become apparent even back then that they just weren't good at running a multi-price point retailer. Now, fast forward to now, you've had a couple of changes in management. Most recently, you had Manuel Riggs, so an activist investor, gain control of the board, bring in Rick Dreiling, who turned around Dollar General, and even he couldn't fix Family Dollar. I mean, quite frankly, I don't think the reincarnation of Sam Walton could fix Family Dollar. And so I applaud them. I absolutely positively applaud them for finally saying, you know what, we can't fix this. Let's sell this and move on.
The question is, Anthony, who, if anybody, do you think is going to step in to buy it?
Yeah, that's a really good question. I think at the right price, there's a buy for just about anything. Now, look, to be clear, it won't be a strategic acquirer. There are no strategic acquirers that make any sense whatsoever. But I could definitely see a private equity firm buying Family Dollar. And I think that the idea would be, first off, don't pay a whole heck of a lot for it. Close a bunch of underperforming stores, just kind of cherry pick the best stores, and maybe bring in the next Rick Dreiling, try to catch lightning in a bottle. One thing that I think that will be on private equity firms' mind is the fact that, when KKR and Goldman Sachs did an LBO of Dollar General back in, I believe it was 2008, and brought in Rick Dreiling, it was a home run investment for them. So I think that they believe that they could do that again.
I don't understand why they couldn't do more with Family Dollar. Why couldn't they integrate the supply chain, the merchandising, and the retail part? Why couldn't they, achieve synergies between these two businesses?
They're just very, very different businesses, right? Dollar Tree, everything or the vast majority of the merchandise is $1.25. Used to be $1. It's a more middle income customer. It's a location that's in a strip mall that's anchored by like a Walmart or a Target or a nice supermarket. It's 50% discretionary, 50% consumable. Family Dollar is a small supermarket. It's 75, almost 80% consumable. It's multiple price points, a lot of price points. It's a lower income customer. It's lower quality real estate. There just are not nearly as many synergies between these two businesses as you might suspect. And unfortunately, as Dollar Tree found out the hard way. Yeah,
even though their names might suggest otherwise. So is Dollar General a winner here, Anthony?
It certainly can't hurt them, right? Particularly if Family Dollar is sold and then the buyer closes a bunch of stores. That would certainly help them.
All right, Anthony, good stuff. Appreciate you jumping on for us. Anthony Chukumba there over at Loop Capital Markets. A closer look right now at Dollar Tree and all the speculation about the potential spinoff or sale of Family Dollar. Dollar Tree shares down about 5.7% here on the day. Meanwhile, we go back to the top of the leaderboard, and that is Nvidia. Those shares higher by 5% here, giving it a market cap of roughly $3 billion, a market cap that, at least for the moment, Scarlet Fu, eclipses even Apple. So that basically just leaves one company ahead of it, and that's Microsoft. Yeah, well, Microsoft is light years ahead of it, but certainly Nvidia giving Apple a run for its money. And the issue here, we talked about fundamentals and that 200% gain it's seen in revenue the last couple of quarters. Analysts have been marking up their earnings estimates, so valuation-wise, the stock actually looks reasonable compared to maybe where it was a year ago. The question is did this go too fast, though? Because, even when you look at those multiples and you look at how long it took for Apple, Microsoft to get to the $1 trillion level, and then that $2 trillion, and then that $3 trillion level, here, I'm sure all the folks at Bloomberg on the other side of the room are going to be counting the days here. But I think this has to be even faster than what we saw. It definitely is faster, and that's why it's giving people pause. And that's going to be a concern. Yeah, that gives people pause, but if the underlying business is there, if the underlying demand is there, and that's what it looks like, it's making chips as fast as it possibly can, then there isn't reason to doubt that it can achieve the numbers it set out. All right, coming up here, we're going to focus a little bit more on the market structure, and more importantly, I guess, the idea that we need a new stock exchange. Some folks down in Texas think they've got an answer that I guess can rival the NYSE and the NASDAQ. That discussion coming up next here on The Close on Bloomberg. BlackRock and Citadel are among investors backing a new stock exchange in Texas. It is part of a big push by the Lone Star State to expand its financial services industry. This exchange would start trading in 2025. Texas also developing a business court system to handle the types of cases that Delaware is known for. And Texas is increasingly luring financial firms with lower taxes and relaxed regulation. Joining us now from Dallas is Bloomberg's Julie Fine. And Dallas is where the TXSE, is as it will be known, will be based. But this will be a virtual exchange, is that right?
Yes, this is going to be all electronic, but yes, located here in Texas. They have their website up. The paperwork is out. The paperwork will be at the SEC later this year, but this group seems determined to start the stock exchange right here in Dallas.
Why, Julie?
I think they feel that it will be easier to do business here, and why not give it a try? And I think they've got some big names behind it. You find, supporting the group when you have names like BlackRock and Citadel Securities. I mean, you've got some behind it. So I think that they believe this is the right time to move forward.
There's a lot of questions right now as to whether this really matters. When we talk about the location of exchanges, that was much more of a critical factor when people were really doing things in open call systems, using paper. Now with everything electronic here, is there any sense that it matters where these companies list? I mean, other than the initial costs to list, what would be the benefit?
Well, I think the benefit would be a different way to do business. A lot of bigger businesses are moving down here. I mean, Goldman Sachs will soon be headquartered right here in Dallas. You have Charles Schwab here as well. Other companies moving a lot of workers down here. So I think they believe this is a good opportunity. The question is, can it really happen, and can it happen on that timetable?
What are you hearing from folks and companies in Texas about the possibility of this stock exchange? Is this something they're getting excited about? Is this only for financial firms, or does this extend beyond that particular industry?
I think companies are excited about it, but not that many companies that we know of have gotten involved, have invested yet. I mean, right now you're only looking at $120 million, but I think people are excited about trying to do more financial business in Texas. They like the regulations here. So really, though, the question is how many people can they really get to back it? And again, like you pointed out, this is all electronic.
All right, Julie Fine, thank you so much. Julie Fine reporting for us from Dallas. And Romain, I wonder if the new Texas Stock Exchange is going to have an opening bell, a closing bell, and have, all this celebration that comes with it, get people to ring the bell.
Yeah, I guess you have to, right?
It's part of it, right?
Yeah, I mean, sure. Otherwise, why not? I mean, let's be honest. When it's all electronic, I mean, I hate to say it, but a lot of what goes on the floor is more for show these days. I mean, we see that at the NYSE.
It's like a museum.
You see that at the NASDAQ. So you need those ceremonial things, and I'm sure Texas will find a way to do it big. Be a lot of hats and boots, I'm sure, and some other things as well.
Yeah. I like that. I can picture the imagery there already.
So they can keep the power on.
Coming up, Shamalia Khan, the head of emerging markets fixed income at UBS Asset Management, will be joining us to talk a little bit more about what's going on in India. This is The Close on Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romain Bostick.
And I'm Scarlett Fu. And on this day, Romain, I know you do on this day in the 4 p.m. hour, but on this day right now, guess what company has a market value of $3 trillion?
Yeah, I love this because now I know 1 year from now, I actually have something already baked in
your calendar.
For one day. I mean, look, it's all the talk of the town. All big tech is back, but no more than Nvidia, which is up 5% on the day and now at that $3 trillion market cap level.
Yeah, the leader of the Magnificent Seven, the poster child for everything AI, and the beneficiary right now, the biggest beneficiary of all the demand for AI software. All right, let's shift gears a little bit here because we want to talk about what's been going on overseas, particularly in the emerging markets. You look at India, and the Prime Minister Narendra Modi has won crucial backing from two key allies in his coalition, allowing him to form a government and extend his decade in power. Now, the nation's markets rallying on the news, recouping some of its previous day's sell-off. Joining us now with more is Shamalia Khan, UBS Asset Management's head of fixed income for emerging markets. Great to see you.
Good to see you too.
So for markets, what does a Modi-led coalition government look like versus a ruling party-led government?
Well, a coalition government is always complicated, but I think the most important thing is that BJP has to reflect now on what led to the losses in the elections. And that is likely to lead to some shift in policy. What they've been doing so far was quite market-friendly, but apparently it was not well received by the electorate. So what our concerns are is that if that shift in policy leads to fiscal loosening, that's not a positive for the bonds of the country.
And what about for the currency of the country?
it's a net negative for all Indian assets. What we are really hoping to see is that the coalition maintains policies that are market friendly, but reality is, in order to gain popularity in general, you have to spend more money.
It was kind of interesting that this election came at the same time as two other relatively critical elections. So I don't think everyone thought they were going to be as critical as they turned out to be. That includes the results in South Africa, but also Mexico. We saw a pretty severe market reaction, particularly in the pesos. I know it's rebounded a little bit today here. But even though the final outcome, meaning Sheinbaum elected, everyone knew that was going to happen. Similar to Modi, the question now is, what's the complexion of that government and what does it mean for the market?
Yeah, we thought the market was being overly complacent about these elections. The reality is, and I'm not sure what it takes for investors to realize this, polls are not predictive. And you really can't follow them. So there were tail risks in all of these elections, and they actually materialized. And what that means is that the risk premium for these countries should be higher going forward. In the case of Mexico, what the government does with a supermajority is going to be key. If they try to pass legislation that is going to be either relating to fiscal loosening or compromising the institutions of the country, that's going to be a negative for Mexican assets.
Do you see right now, based on what we know, an investment opportunity there? And I'm talking like new positions, not people who are already
I think
invested.
you should be cautious.
Yeah.
I think you should be cautious until you understand what the policy mix is going to be going forward.
When you say the risk premium should be higher, how will we know when we've reached a point where it's about right?
Well, that's something we analyze every single day, and that's why you need active management in these countries. These have been consensus bets. Everybody has loved Mexico and India. The reality is we have found value in countries that are much less loved, the distressed countries in emerging market, sovereign dollar-denominated debt, countries like Argentina, Egypt, Angola, and even some countries that are going to emerge out of default this year, like Ghana and Sri Lanka. We prefer to avoid these consensus bets, and especially with some of these tail risks materializing, we think that you have to be cautious going forward and continuously assess them to see what policy mix is emerging and how much risk premium is warranted.
What about folks who don't need to be in emerging markets at all? I mean, we talk about the risk premium, how they should be higher, and you're talking about looking at markets that people don't love right now. It's a high bar for people to get to if it's easy for them to make 5%, 6% somewhere else at a risk-free rate.
It's an excellent question. The reality is the countries that we've liked have been up as much as 30 to 50% in the last 1 year. So I don't think this is an opportunity that investors should mix. The only difference is you have to really do your homework and choose the right countries.
Is the rate story, though, going to start to work in their favor? I mean, we've talked a lot about central banks starting to lower rates. We saw that from Bank of Canada. The expectation is ECB tomorrow, and it might be a while before the Fed gets there. But we're starting to see the direction that monetary policymakers are looking, and at least for right now, they're looking down.
Absolutely, and that is going to be another tailwind for emerging market fixed income assets. So we don't think this is an area you should absolutely ignore. There are going to be countries that perform better versus the other ones, and that's our job to basically create alpha for our investors.
We can't talk about EM without talking about, I guess, the biggest EM country out there, which is still China. We don't talk about China anymore. I feel like it's like, the uncle that we keep in the attic that nobody wants to talk about. Are we going to see a rebound there anytime soon? Do you anticipate one?
We are constructive on China fixed income assets. The reason being is because so much negativity was already priced in. And we believe the government is serious about addressing some of the structural and liquidity issues in the housing sector, which is key to maintaining the growth levels that you are mentioning. So that, to us, is still a very attractive opportunity. And again, much less loved by the market, as you mentioned.
Because there's almost no uncertainty there. I mean, I know people are like, oh, okay, when's the growth come back? But, I mean, nobody's questioning what Xi Jinping's policies are going to be over the next couple of years. I mean,
absolutely.
He's telegraphed
and look, the China high-yield assets have performed extremely well. I mean, they're close to U.S. equity markets, which is a difficult feat to accomplish.
So bottom line, Shamalia, what should the leaders of these countries, Mexico, India, South Africa, what should be their takeaway from investors and from their own electorate?
So there's a different takeaway from investors versus the electors. The investors want policy continuity. Policy continuity has unfortunately not worked for India and South Africa. So they will basically be looking to see what they can do differently without impacting the markets. In the case of Mexico, it has clearly worked. So if they continue doing what they were doing, that would actually be a positive. But, having the supermajority can be a temptation.
All right, Shamalia, great stuff here. Shamalia Khan, one of the best in the business, UBS Asset Management's head of fixed income for emerging markets. A closer look at those emerging markets, Scarlett. And when you look at the MSCI Emerging Markets Index, the big sell-off we had last week, the big sell-off we had yesterday, we are seeing some of those losses get recouped today, as a lot of people now, I think, are kind of taking a cue from, I think, what Shamalia was talking about really here, is that maybe the sell-off was a little bit overdone.
Maybe it's a little overdone, but the shock of the election results, perhaps giving people a reason not to look at emerging markets right now, because they're like, I don't need to, get involved in all of that. I can get my return somewhere else.
Yeah, I mean, and where else can you get them? You come back to you come back to the U.S. here. We still remain king, and Nvidia is at the top of the hill right now, a $3 trillion market cap, as that stock continues to power higher here. We're going to have a fuller breakdown here of some of the moves out there and just how fast Nvidia went from next to nothing to one of the most valuable companies in the world. This is Bloomberg. All right, welcome back. It's time now for our stock of the hour. A closer look at shares of Nvidia, rising 5% here on the day, setting up at the close for what could be the third stock ever to close at a $3 trillion market cap. Abigail Doolittle joining us right now to talk a little bit more about this. And Abigail, I was just going through the Bloomberg terminal and looking at this. It took 2 decades for Nvidia to get to that $1 trillion market cap. It took less than a year for them to get to the $2 trillion, which we should point out was in March of this year. And now 13 weeks later, here it is perched on the precipice of a $3 trillion market cap.
Is that another way, Romaine, of saying it went parabolic?
I think so, yeah.
And parabolic...
And you compare that, sorry, not to cut you off, but you compare that to Apple. Took a lot longer to get to that level. Similar story with Microsoft.
Yes, and I think that the point you're making is maybe too far, too fast. And that's the definition of a parabolic uptrend. And they typically do reverse to some degree. From a physics standpoint, it's 90 degrees up. That cannot hold, with the exception of Tesla back in 2013 or 2014. Will Nvidia turn out to be a Tesla with relative to this massive rally? It's hard to know. But also, I mean, this was a $2 stock back in 2010. We're now looking at a $1,200 stock. Since the pandemic, just 4 years ago, up 13%. We're not talking about small numbers either. Now, the numbers, speaking to revenue, are there. Last year, for the fiscal year that ended in 2024, their revenues grew 126%. The thing is, we've gotten so used to these big numbers, these big guides. I mean, last May, when they put up a revenue guide that I think it was 51% better than what the street was expecting, I don't remember ever hearing about that before from a big company. But at some point, it seems likely that's going to stop. And it really depends on AI. I mean, I think we're all still trying to discover, is AI, it certainly is not blockchain, which, seemed to go the way, but is it the internet? The interesting thing, though, too, and this to the point you make about it being $2, I don't think you can find a stock or a major company out there that has had that type of run-up and that didn't turn out to be like a complete house of cards. Because there's legitimacy, and I think Scarlett was getting at this a little bit earlier, because when you talk about multiples and whether that growth is justified, this is a real company making real things, generating real dollar bills. Yes. Well, it's interesting you're saying that, Romaine, because I had enough time to write down one note, all things AI. This is the Amazon of AI. Is what Amazon was to the internet. And Amazon was, I think, a 30-cent stock, and then has kind of done a similar thing. So to your point, this is the real deal. Now, the question is, when will we see some sort of a pullback, and what will potentially cause it? I think that when AI has its first hiccup of some way, when there's headlines that it's not quite as big as we don't know that. We really don't know that yet. But there are going to be hiccups along the way, just as there were for the internet and other technologies.
And I think a lot of people are looking forward to that hiccup because it's a way for them to get in.
I
look
agree.
at the analyst ratings on Nvidia, and 65 buys and 7 holds and 0 sells. That is a 90% buy rating.
It's incredible.
On this company, right? I mean, it is a hardware company and has a profit margin, a gross margin that's expected to rise to 76% this year. It's a hardware company with a gross margin of 76%.
It's incredible, and that's a great stat. Another one is right now it's trading almost...
Hardware company. It's at this point, it's a monopolistic hardware company because you're not getting those chips from anywhere else, at least for right now.
At least for right now, From the stock standpoint, right now, it's almost 100% above its 200-day moving average. It's done that a few other times in history. During the bubble, it went well above, but that's a long way of going back to the parabolic uptrend, and then at some point that there's going to be some consolidation. Again, what will be the trigger for that? It's hard to say, but yeah, that buying opportunity, people are going to be really pretty excited for
They're excited about the potential hiccups and the potential pullbacks because, yes, Nvidia shares, you could say they're relatively expensive, 39 times expected profit over the next 12 months. But before the May 2023 earnings report, they were trading at 60 times forward earnings. So it's seen as relatively cheap.
The E is going up.
Yes, they keep marking up the E.
Yeah, and that's what I mean. It's like when you look at any type of stock that's had this type of parabolic move, few of them had the fundamentals that Nvidia had. So I don't know if that means it's justified, but it's certainly a lot more justified than, I don't know, let's just say GameStop.
And the valuation in its 5-year range is actually near the lower end. The one question is, though, when will sentiment shift?
Yeah, gotcha.
Again, lots of people waiting to get in. Abigail Doolittle, thank you so much as we continue to track Nvidia's gains, currently up $54 at $12.18. This is before the stock split next week. $3 trillion market cap for Nvidia. Coming up, we've got Steve Sosnick. Oh my God, he's mocking me. Steve Sosnick is coming up, Interactive Brokers. This is The Close on Bloomberg.
This is the countdown to the close. Romaine Bostick alongside Scarlett Fu with record highs right now on the S&P and NASDAQ. We could thank a lot of the big tech stocks, Scarlett, but I think there's only one that anybody wants to talk about.
Yeah, it's the one that so many people didn't know how to pronounce up until the last year. Nvidia. I go with Nvidia. And I think Jensen Huang does too. But whatever you want to call it, it is now a $3 trillion company because its market cap exceeded $3 trillion for the first time today. That makes it more valuable than Apple and just trailing Microsoft, which is what, worth $3.1 trillion?
Yeah, 3.1 trillion, and we'll see the neck-to-neck battle right now between Apple and Nvidia. I guess will be settled over the next 9 minutes here, and it's kind of fitting right now that as we count you down to the close. Joining us right now is Steve Sosnick. He's the chief strategist for Interactive Brokers, and actually one of the folks who gets credit for coining the term the Magnificent Seven. And a couple of years ago, when we started using that term, I think Nvidia was like trading just a few $100 a share, and now, of course, it's over $1,000. Although we got a big stock split coming, and now at a $3 trillion market cap. When you sort of singled out those 7 stocks as being the real drivers of this market, did you think Nvidia would really rise to the top?
Well, first of all, hello, Romaine. I thought it was going to be one of the best stocks, and certainly thought it had many more prospects than the others because it was already starting to generate the growth and the excitement and the AI enthusiasm. As early as like February 23, I think I did a count at how many times they used the word AI in their conference call. And it was like 82 times or something insane. I don't remember offhand, but they leaned into it early. So yeah, once this AI became the investment theme, Nvidia became the stock to watch. But at this point right now, my thesis is it's Nvidia's market. We're all just trading in it.
Yeah.
Absolutely. And it gets to this idea, too. I mean, we talk about how a lot of times market moves really run on narratives. And obviously AI, and for that matter, Nvidia, have had kind of the ultimate narrative. But baked into that also is the idea that this was a stock, even before this run-up, that was already favored by retail traders. The institutions, to a certain degree, followed. And it's just kind of created this groundswell that just seems unstoppable.
Well, you know, what's amazing about NVIDIA is the way they can pivot. Remember, this was the cryptocurrency play.
Yeah.
This was the bricks and mortar for Bitcoin and the other stocks.
And before that, it was video games.
Before that, it was video games.
Yeah.
I give these guys an amazing amount of credit for just pivoting and knowing what the next big thing is in advance. Now, all big things run their course, and so I don't know what that is, and quite frankly, Mark Zuckerberg's comments in Facebook, in Meta's last conference call, where he said, you know, it's going to cost us billions of dollars, and I don't know when this AI investment is going to pay off. That to me is a little problematic because it does mean at some point, if Meta's having trouble figuring out how to make this a bottom line issue, at some point the chip spending slows, but there's been no sign of it because they raised guidance yet again. So here we are off to the races. A lot of that, of course, is propelled by the split.
Right, but the CapEx is going to be something that'll take a couple of years to pay off. And in the meantime, the orders are in at NVIDIA, and they're trying to fulfill them as quickly as they can. Abigail was talking earlier about how the question is, when does this momentum stop? When is it due for a pullback? If there is a pullback, everything that you've seen on your platform suggests that there's a mountain of people waiting to rush in the minute there's a pullback.
Yes, but I think a lot of them have been rushing in. Remember, we have a lot of momentum traders on our platform too, and so I think a lot of them have been rushing in. I think a lot of the momentum has actually been driven by people who'd been writing calls, then finding out, I'm about to get called away. And by the way, not only do I not want to get called away, but I'm going to have to pay taxes if I get called away. So then they rush back and buy the calls, and it becomes this weird feedback loop.
I see.
So there's a lot of this is a momentum animal right now. My fear, to some extent, is that it's a bit of buy the rumor, sell the news based on Monday. We'll know the answer to that Monday and Tuesday.
So let's just say that you want to get into Nvidia, but you don't necessarily want to jump in front of a speeding train. What's the next best play? Is it AMD? Is it Intel?
I'm not a semi-analyst, but I would say certainly ARM that is benefiting tremendously from Nvidia because they use a lot of ARM design. AMD is sort of the also-ran. If you can't get the Nvidia chips, well, I might as well take the AMD chips. But I think right now it's just everything following in the wake, and it's really I think Intel is a little behind on the game, but it's just so much. To me, that this has whiffs of the internet era, but not necessarily exactly the same, because the internet, remember that in '99 and 2000, unfortunately, you two are old enough to remember this.
Those were the eyeball days, right? Everyone's like, we're counting eyeballs.
But the promise of the internet was amazing, right? And it actually lived up to it. But the initial hype, it took years for that to develop, and that's the one thing that sort of nags at me a little bit is what happens. Yeah. What happens when the fervor just normalizes?
We'll get to a broader question, too. I mean, we kicked off the show, kicking off to the close about an hour ago with a discussion about this latest market pulse index that Bloomberg puts out. And it's backwards looking, but it basically showed in May that the risk sentiment had gotten so high that it had basically become that proverbial contrarian signal. The idea that, okay, when it's this high, the next trend is going to be downside. When you look at the broader market, so much broader than Nvidia here, do you think sentiment right now is maybe a little out of whack?
I do. I think sentiment, by several different measures, sentiment is very euphoric. The VIX is off its lows. I mean, we're at least when I last looked at a 12 handle in the high 12s as opposed to like 11 and change.
12.6 right now.
But when I look at certain individual stocks, I see basically no risk aversion in Apple, and in Nvidia ahead of their earnings, ahead of their events next week, the split and the developers conference. But yet on the other hand, I am starting to see some risk aversion creep in to SPYs and Qs because there are big global events as well. But in general, people are euphoric.
But given the weighting, though, too, I mean, you mentioned Apple and its worldwide developer. That stock on an 8-day run, kind of a stealth rally there, hasn't quite got back to its record highs, but it looks like it's getting close to it. It raises the question, though, too, about their influence over the market. So if we do get a hiccup in Nvidia and maybe you get a slowdown in chip sales, or Apple for some reason comes out and does nothing on Monday and everybody decides it's a dog, is that going to drag the whole market down?
You have no choice. I mean, as I mentioned with the feedback loop about Nvidia, if it breaks, it's dragging us up. If there's any significant break in Nvidia, that's my big fear before every earnings event, which is that if they fail to deliver, if they fail to guide higher at this point, and you get a pullback, it changes the whole sentiment of the market because so much is wrapped up in these stocks.
All right, Steve, got to leave it there. And we didn't give it a chance to talk about GameStop. They're up 17% today for reasons unknown to everyone. Steve Sosnick over at Interactive Brokers, a conversation here about market sentiment, and I guess ostensibly, really, Scarlett, a conversation about Nvidia.
Yeah, absolutely. And this whole market's been about Nvidia for the past year when you come down to it, right? We all talk about how narrow the rally has been, how it's been on the back of one company and one theme, and that theme is AI, and that company is Nvidia.
Yeah, well, in terms of percent gains, there are a lot of other stocks moving, including GameStop, CrowdStrike, Hewlett-Packard, and a few others. So some folks out there are finding a way to broaden out, I guess, what they buy to the downside. The biggest decliners, Dollar Tree, Brown-Forman, and Logistic Properties. As we move closer to those closing bells, sit tight. Full market coverage coming up right here on Bloomberg as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu. We're counting you down to the closing bell. And here to help take us beyond the bell, it's a global simulcast. We're joined now by Tim Stenovic and Molly Smith, Carol Masser and Alex Steele on assignment today as we welcome our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube as a neck-and-neck battle right now, Tim, between Nvidia and Apple for market cap dominance.
Yeah, $3 trillion
continues
versus
into the close.
$2.99999 trillion is the latest that I saw when it came to that battle. But we do still have about a minute before the markets close. So as they say, Molly, anything can happen.
I don't know, man. That would be pretty wild if that did not hold on in the next, gosh, what do we have, 30 or so seconds here until the close. But I mean, really, if it still doesn't have AI in the title, I mean, what are you doing? You got to be involved in these kinds of stocks right now. Saw it with Nvidia, saw it with HPE today, and we talked about how Apple is really just lagging in this game. So it's just going to be a race of who can get out in front of AI the fastest.
I'm looking at the most actively traded stocks by value. So this is the companies with the most money moving through them. Nvidia has $54 billion worth of shares changing hands today. That is more than 5 times the next most active stock by value, which is Tesla at $9.2 billion. That just gives you a sense of how much money it's sucking up right now.
Yeah, and we talk about also the volume on the shares right now, 47 million shares, biggest volume mover, Hewlett-Packard, but that's more of a reflection here of the difference in valuations. GameStop also getting a nice bid on the day, up about 19%. Tesla, modest gains on the day after being in the red for a good portion of it. This is one of those days where you do clap and cheer because you are looking at record highs for at least 2 of the major indices. That includes the S&P 500, which is going to close higher by about 63 points or about 1.2%. It takes a while for these numbers to settle, but the NASDAQ composite also higher by 330 points or roughly 2% on the day. The NASDAQ 100 up about 2% here on the day as well. The Dow Jones Industrial Average higher by 96 points or 0.3%, and the Russell 2000 going to close out the day higher by 1.5% here. But the big drum roll here, guys, is who finished higher on the day in market cap, Nvidia or Apple?
All right, I'm doing the calculation right now, Romaine.
Well, I'm just looking at my terminal. Right now, Nvidia edging out at 3.008 billion, Apple at 3.003. We should point out these numbers will shift a little bit as our number crunchers wait for final settlement.
Okay. Trillion, rather, right?
Trillion, thank you.
Perhaps no surprise if you've been following the trade today. Mega cap tech just absolutely dominating today. The S&P 500, though, did see 324 stocks advance, Scarlett, and 177 decline.
And that is why the IMAP, the big pie, is basically all green because tech, which is the heaviest weighted sector in the S&P 500, is up 2.7% as a group. Your weak links are utilities, consumer staples, and REITs. They are among the smallest sectors within the S&P 500.
All right, let's take a look at, we still got earnings coming at us, guys. I want to talk a little bit about Five Below. Second quarter net sales forecast did miss estimates, those coming out just moments ago. The company sees second quarter net sales 830 to 850 million. Estimates were for 879.5 million. The company sees second quarter earnings per share coming at 57 to 69 cents. That's way below estimates of $1.01, and sees fiscal year net income from 275 million to 297 million dollars. I do want to get to some of the gainers that we have. Oh, and I should say the stock down in the after hours right now.
Ooh, a lot.
Wow, it's taking a real hit because of that fiscal year second quarter EPS, I should say, coming in way below estimates, down double digits right now. Let's get to some of these gainers though, because we got to start with Nvidia. Market cap hit $3 trillion today for the first time. Shares just have rallied 147%. Or so this year, adding about $1.8 trillion as the demand for AI chips used to power AI tasks has just skyrocketed. As Romaine mentioned, it is neck and neck with Apple, but did surpass Apple today. Get this, guys. At the beginning of 2023, it was a company that had a market cap of about $360 billion. It's up more than 750% just in the last 18 months or so. Also, Hewlett-Packard Enterprise.
I got to get me one of these chips now. I feel like it's all the rage, right?
The Blackwell?
I don't know. I don't know. Is that
Get in line, Romaine.
I was going to say.
I mean, why not? It's a hot thing, right?
Yeah, just got to call up Meta or Elon Musk.
The wait list is longer than to get a Birkin bag.
Just call Elon to get one of those.
Yeah. Okay. Which company do I need to call?
XAI is the one I believe that has all the chips. Yeah. He'll hook you up. Hey, speaking of AI, Hewlett Packard Enterprise, HPE, hitting an all-time high. Also related to AI, also related to Nvidia, after the company reported better than expected revenue fueled by sales of servers built for AI. Increased demand and better availability of high-powered semiconductors from Nvidia led to the increase in AI system sales, according to Antonio Neri in an interview with our Bloomberg News team. Shares higher by 10% on the day today. And then here's one that is related to AI and machine learning, believe it or not.
What's that?
Sweet Green.
Machine learning and AI?
The salad chain, okay?
Are they
12% today.
Okay.
Highest intraday going back to March 2022. The company participated in a fireside chat at the William Blair 44th Annual Growth Stock Conference.
Fireside. Is there actual fire?
A little warm for a fire.
Okay.
The company discussed urban and suburban stores, machine learning data.
Machine learning.
Unit productivity, new store learnings, among other topics.
Oh.
Machine learning when it comes to salad.
Oh, okay.
Yeah. That's your AI. That's your AI story right there.
Did that stock hit a $3 trillion market cap today?
Not today. Not today.
And I'm going to tell you, there wasn't a lot for me to choose from here to go into the decliners today. Really green all over the screen today, but a few of them not so lucky. So let's start with Madrigal Pharma. This is a company that is developing therapies for metabolic steatohepatitis. Sorry, I've kind of matched that a little bit, but it's a liver disease. And these are companies that were falling today after a data abstract from a trial of Eli Lilly and Co.'s experimental GLP-1 drug to treat patients with the disease. So we saw Madrigal fall today, also 89 Bio Inc. shares down on the day as well. Let's take it over now to Brown-Forman. These are down. These shares also ended the day down.
That's alcohol, Tim.
Yeah, that's right.
I heard.
Doesn't seem like there's an AI story in here, so maybe that's why it's down. But after the alcoholic beverage maker reported revenue for fourth quarter that missed expectations, also missed the forecast for organic net sales for next year. So those shares down today. As well over at Brown-Forman. Last one, let's get over to some fertilizer stocks. These were retreating as Egypt is expected to resume nitrogen output. So then those had been disrupted by natural gas supply shortages. So not looking so good today for CF Industries. Also Mosaic, Nutrien, and Yara International were down during the day.
All right, let's get to some of the big movers here in after hours trading. Lululemon shares up 11% right now. The company reporting earnings for the first quarter, looking at EPS coming in at $2.54 a share. That's a beat. The street on average was looking for $2.39 a share. Revenue came in pretty much in line with estimates at about $2.21 billion, and comp sales overall were up about 7% when you X out the FX effects. Now that's slightly below what the street was looking for, but here's your guidance. 2Q net revenue, 2.48 to 2.42 billion, 2.4 to 2.42 billion. That looks a little bit light. EPS 2.92 to 2.97. That also looks a little bit light here. Nevertheless, you're seeing the shares rise, and maybe that's on the back of a $1 billion buyback program.
This looks like relief that the numbers for the first quarter were not worse, because they had guided for a 9 to 10% increase in sales, and that's pretty much what they delivered on. And this is a stock that is down 40% this year, so it has the second worst performance in the S&P 500. It's down 36% since its last earnings report. So relief that the first quarter came in as expected. But you're right, that second quarter forecast, both on the top line and the bottom line, disappointing. I'm surprised it's still gaining this much given that forecast.
I think it's fair to say it's a relief. I mean, you mentioned the numbers there, Scarlett, down 40% so far this year. It's been one of my decliners many times throughout the year because of the challenges that it's faced. Plus, you have the executive shakeup in recent weeks that saw the departure of the individual in the C-suite who's responsible for new products there. So a lot of questions about the future of the company, which I'm sure Calvin McDonald will get asked on the earnings call a little later today.
Right, and we did have him saying at least that U.S. consumers are, quote, still spending, but I think that they're being selective of where they spend and what they choose to buy, is what Calvin McDonald said in an interview. Interesting, because if I'm thinking of a U.S. consumer being selective, I don't know that I would think of Lululemon benefiting from that, personally.
Yeah. Well, it's interesting, too. I mean, I'm looking, it looks like their inventory came in a little bit under where it was, which is a good thing, at about $1.35 billion. And operating margins also came in above estimates as well. So maybe there is some hope here, particularly for a stock. Let's face it. I mean, last time I checked, as of yesterday, it was the third worst performer in the S&P 500. So that might have a lot to do with the market reaction we're seeing right now. now.
I think you guys mentioned this, but the fact that they have talent leaving and they're dealing with increased competition has raised a lot of questions about how it moves forward. I mean, you can limit your selection, you can publish new, make new leggings in different colors, but how many pairs of Lululemon leggings does anyone
What about
person
those
need?
shoes, Scarlett?
They're terrible
You're
looking.
a shoe person.
No,
They also have
you looked at them too. You weren't a buyer.
They have the men's clothes as well.
Yes.
I will say the company has been counted out in the past, and it has come back from challenges in the past. So
yeah,
we'll see under a different CEO. So
do you
we'll
wear Lululemon pants, Tim?
I have a pair. I have a pair. Yeah, I will say I don't wear them anymore.
Oh.
Yeah.
Ooh, wow.
Yeah.
That's telling. Okay.
Yeah, bearish.
Yeah,
I would say.
I just want to be honest. I'm not saying one thing or the other. You asked me a question.
No, you got yourself in trouble.
You get an honest response. Okay, you know what? I got to leave it there else before I get in any more trouble. That is going to do it for Beyond the Bell. It's our cross-platform coverage of the market close here on Bloomberg TV and radio, Bloomberg Originals, and YouTube. We're going to see you same time, same place tomorrow.
All right, our coverage continues here on Bloomberg Television. A deeper dive into those earnings out of Lululemon. Some other retailers also reporting, including Five Below and Victoria's Secret. We're going to talk to Morty Singer over at Traub Capital about the apparel industry. That's coming up next, right here on The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic here on a busy Wednesday afternoon. Stocks here in the U.S. hitting record highs as a risk-on appetite re-enters this market. It started this morning with a big sort of services report coming out of the ISM that really put a bid under all risk assets, a bump up in Bitcoin, a drop in the VIX, and that rally in the Treasury market continues. But as we got closer to the end of the day, it was all about what we saw in the chip space. A Philadelphia Semiconductor Index up 4.5% on the day, an S&P 500 up more than 1 to a fresh record high, with Scarlett more than a quarter of those gains all on the shoulders of one company.
Yeah, and let's take a look at that one company. It is Nvidia. It's been the stock market darling for so long. It's now trading at $1,224, up more than 5%. That's a gain of $60 in just one day. And that is really our top story this hour. The incredible rise of Nvidia today, this week, this month, this year, and over the past year. You add it all up, and Nvidia is now worth $3 trillion as a publicly traded company, making it just as valuable as Apple and trailing only Microsoft. Now, driving Nvidia's rise is the seemingly bottomless demand for its chips used to power artificial intelligence, which, let's remind you, rivals like Advanced Micro Devices are desperately trying to play catch up on. Nvidia's sales growth has topped 200% for 3 straight quarters. Its gross margin will be in excess of 75% this year, and this all comes before a 10-for-1 stock split on Monday, which will make it all the more attractive to individual investors.
All right, Scarlett, Kunjan Sobhani joining us right now, senior semiconductor analyst over at Bloomberg Intelligence, to talk about this phenomenal run for Nvidia. And Kunjan, I think it's important here that we don't just talk about the stock price, but we talk about some of the things Scarlett just mentioned, and that really is the fundamentals here, the revenue growth, of course, the profitability. When you look at the fundamentals here, do you see room for this stock to continue to move higher?
I mean, definitely, we do see consensus numbers expect about 100% growth in fiscal 25 and about 30-ish% in 26. But the more important than just these percentage growth is the scale. I mean, how many times have we seen in the recent past a $60 billion revenue company grow by such accelerated growth rates?
Yeah, that's a great point, and it's what is exciting investors, and certainly it's driving that stock price higher. When it comes to any kind of potential slowdown or any kind of hiccup even in the transition from its current chips to Blackwell to the next generation, could that be something that might, I don't know, halt this rally for a little bit and provide a pause, a breather?
I mean, definitely, I think the bigger risk right now is sort of a headline or an emotional sentiment risk rather than fundamentals. So any sort of a hiccup, whether it's news-wise, whether it's execution-wise for its Blackwell or even the next generation devices in 26, could definitely cause some volatility given where the stock and the valuation is right now. So that's definitely, but rather than that, I think in the long term, it would be a temporary timing misstep, but it could cause volatility in the stock.
All right, Kunjan, always great to talk to you here. Kunjan Sobhani over at Bloomberg Intelligence. A closer look here at Nvidia shares, a massive rally here on the day, taking it to a $3 trillion market cap. Of course, that is the second best gainer in the S&P 500 on a year-to-date basis. The second worst performer on a year-to-date basis is Lululemon. That company just reporting earnings, and maybe investors breathing a sigh of relief as the share is moving higher by about 12% here in after-hours trading. Morty Singer, managing partner at Traub Capital Partners, joining us right now to talk a little bit more here, I guess, about this sector, and I guess specifically with Lululemon, because Morty, this really seemed to be the apparel darling. It could do no wrong. It was the hottest clothes out there for women, eventually for men here. They held firm on pricing. And then, I don't know, over the last year or so, it just seemed like it just kind of lost some of its cachet.
Well, look, I think what you're experiencing through this stock is ultimately the transition of an incumbent that is now an incumbent but had been a challenger, and the challenger growing up to an incumbent and now finding challenges of its own is what's going on here. So there's a lot of competition out there, some ankle biters chasing them across the whole line of the industry here and overseas. And I think there's also a changing of the guard generationally, because ultimately, when you get to become the size that they are, you have to figure out who your customer is. And they've added men's. They have a younger generation they have to appeal to, who, by the way, seem to love it. Mm-hmm. So I think there's a lot to like here. But there's also people scratching their heads about how to continue this tear of growth, which is still growing at quite a good clip, quarter to quarter going forward.
Okay, you mentioned competition, and people keep talking about competition, but let's talk about that landscape more specifically. Is it overstated? Because who is taking market share from Lululemon, and who is Lululemon taking market share from? Are we saying that Athleta, which is the athleisure brand of the Gap, is a viable competitor to Lululemon, or are we saying it's someone like Vori or Alo?
I think it's actually all of the above. But if you look at, for example, this quarter, these guys did $2.2 billion approximately, I think it was, in revenues in the quarter for Lululemon. That is the same size as the entirety of Athleta in 1 year. So to your point, Scarlett, this is a much bigger competitor, but there are many ankle biters, and you named a few others that have been, obviously those companies are doing hundreds of millions of dollars a year, so it's really not that large. But they're also having to figure out how to appeal to all these different customer cohorts who are also finding these clothing and apparels that they wear in different areas of their life, even in the office. I mean, I walked out into the street today, and there were 7 guys wearing office wear that was apparently, according to one of my colleagues, all Lululemon. So they are adding customers, they're expanding the tent, but when you do that, you also lose some of the cool factor.
Yeah, well, someone just walked by here in a pair of Umbros, so I think times have changed, Morty. I do want to ask you about another company that is, I guess, kind of a turnaround story, or at least trying to be one, and that's Victoria's Secret. Their earnings are just out right now, pretty much coming in line with estimates on the top line and beating estimates on the bottom line. But it gets to a broader question, Morty, about when a brand does lose its cachet and it loses its hold on the zeitgeist here, how does it sort of regain that, or can it?
Well, it certainly can, and I think you were seeing that happening at Gap. You've seen it happening at Abercrombie & Fitch as well. And I certainly think that you're going to see that continue with Victoria's Secret. They've had a tough few years, but when you can actually try and speak to your customer and listen to them and understand what they need, you can start to see gains, not just here, but around the world. I mean, the international footprint for Victoria's Secret is also a great asset for them, and I think it will continue to be so. And they've got that invested, footprint out there, which will be able to be quite significant growth for them if they actually put the right product in there for those customers.
And I think they also brought back the traditional fashion show as well, as to kind of bring back some of its glory days. Morty, thank you so much, as always, for joining us. Mortimer Singer is managing partner at Traub Capital Partners, giving us his expertise on the retail space. Coming up, the top 3. We focus on the top 3 movers and shakers at the center of the day's big stories. This is The Close on Bloomberg. It's It's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Ray Dalio, the billionaire investor flagging U.S.-China economic warfare among the top global risks this year. And that's in part, he says, because both Democrats and Republicans they're each, and as a result, everyone's pursuing anti-China policies in an election year.
Yeah, it was interesting in his comments. I mean, too, he talked a lot about kind of like how he thinks people should position market-wise, the idea of sort of maybe stay a little bit away from duration for the moment here. Look, it's so hard to game this, right? I mean, we talk about, do elections really have a tangible impact on the markets? I mean, some would say no. Obviously, there's a lot of speculation around it, but I think when you look at the correlations...
It affects sentiment and mood. Look at what happened with India and Mexico.
Yeah. Hopefully we're not India or Mexico, but maybe we are.
Some would say otherwise.
We could be worse for all we know. I'm keeping an eye on someone else, and that is a new CFO over at Google. They're taking the CFO over at Eli Lilly, Anat Eshkanzi. She's going to be replacing Ruth Porat. Of course, Ruth Porat kind of sort of stepped aside, and they've kind of been saying they've been searching for a replacement for her after her many years of service there. So at least on paper, I mean, she looks like a phenomenal pick, and I guess, it seems like an upgrade for her to go from Lilly to probably what could be the next $3 trillion company in Alphabet.
Good point. And her job, of course, is to manage Alphabet's books as the company invests heavily in data centers to meet the AI moment and compete for talent with everyone else, like the Nvidias of the world.
Yeah, absolutely. Here.
All right, the third person I'm watching is Sam Altman. His OpenAI and Apple are partnering up to integrate ChatGPT into the iPhone. This is going to be a key focus on Apple's Worldwide Developers Conference Day next week. And it really shows, Romain, how much the power dynamic in Silicon Valley has shifted over the past 15 years.
I just hope they deliver on this, right? Because it's so funny. Whenever we talk about Apple and AI, I thought, wasn't Siri supposed to be AI like years ago? And then we all know that never really matured, at least not to the level I think we expected it to.
I never liked Siri.
And it's just like, I don't know, if they can improve that, great. But I mean, these splashy deals and God knows how much money they're giving this guy, just fix Siri, dude. Tim Cook watches this program. I'm pretty sure it's his second favorite program on the network.
What's his first favorite program? I'm pretty sure also that this OpenAI partnership is a temporary thing until Apple figures out its own thing. That's been its playbook.
Well, that's been its playbook, right?
Right? Yeah.
Absolutely. Good point.
Okay. Meanwhile, a near-decade-old lawsuit against the National Football League's Sunday TV lineup is now coming to light. Joining us now to explain why that is Bloomberg's Maxwell Adler. Max, let's talk through what's going on here. We're talking about the NFL Sunday Ticket, and there's a lawsuit. What exactly are the plaintiffs accusing the NFL of?
Hey now, and thank you for having me. So essentially, NFL Sunday Ticket consumers are saying that they were forced to pay artificially inflated prices for a package of out-of-market games that they didn't even necessarily want. And they're accusing the NFL of conspiring with DirecTV, their old television partner on the Sunday Ticket package, of conspiring to create an illegal monopoly out of these out-of-market games with the Sunday Ticket offering. So to lay it all out for y'all, I'm a big New York Giants fan, but I live in Los Angeles now. So the only way that I could watch the Giants most weeks is for me to buy the entire Sunday Ticket package. But that includes every game from every team. There are no individual team packages. I have to buy all of them or none of them. And this is not the case for other leagues like the NBA and MLB that allow their teams to sell individual media rights to their regional broadcast partners. And those leagues offer single team packages for out-of-market games. With the NBA, it's their League Pass offering. And with Major League Baseball, it's with their extra innings offering.
All right. Well, I mean, but going back to the NFL, though, I mean, let's just play devil's advocate here for a second, Max, because this gets to the idea that why should it have to change? I mean, I understand the lawsuit, but the NFL has made their argument very clear, and I'm not sure why it has to change. I mean, as consumers, I know we want it to change, but what's the rationale?
Yes, the league is arguing that they're protected by the Sports Broadcasting Act of 1961, which allows them to collectively sell their media rights to large national networks. The NFL is also arguing that they have perhaps the most fan-friendly package of any of the four major North American sports leagues. You know, like local fans are allowed to watch every single one of their team's games on Sundays on either the Fox or CBS affiliate, and that is not the case for the NBA or the MLB, where they consumers would have to buy the regional sports broadcast network through a cable package. So we'll see what happens. The trial starts tomorrow. That's when opening arguments are. And there's a whole list of big name witnesses, including NFL owner Roger Goodell and possibly Jerry Jones and the owner of the Patriots, Robert Kraft.
Wow, it's a nice lineup of folks there. That should be interesting. Maxwell Adler, a closer look here at the NFL's pursuit, I guess, or defense, I should say, here of everyone. Everyone just wants a free ride, Scarlett. I'm actually on the NFL side on this.
You are? How do you watch your Bears games?
I don't.
Don't you have a favorite football team that's not the New York
I do.
Giants?
I'm a Chicago fan through and through. But you know what? I just kind of gave up on it. I mean,
You made your peace. You said, okay, NFL, you win.
I got other things to do, Scarlett. Sometimes you just take the L, Scarlett. It's just life.
I don't know, Romain. You don't take the L very, very frequently, so I don't buy it.
All right. Well, on that note, when we come back, Scarlett, how about this? I'm going to give you a challenge here. We're going to take a look back in history and the birth of Adam Smith and the advent of modern capitalism. Here's a question for you. Which famous economist also shares a birthday with Adam Smith?
It's not Tom Keene, because his birthday's in December.
This is Bloomberg. All right, on this day in history, June 5th, we look all the way back to 1723 and the birth of Adam Smith, the father of modern economics. His seminal book, An Inquiry into the Nature and Causes of the Wealth of Nations, is still, more than 200 years later, the most referenced and the most misinterpreted text on free market capitalism. At the time of its publication, Wealth of Nations was by far the most comprehensive work on economic theory, legitimizing the idea that economics itself was indeed a science, albeit a dismal one, but one that could be measured, tweaked, and even gamed. Smith's theories introduced the world to the concepts of free markets, of division of labor, of social prosperity, but most importantly, he introduced the idea of that invisible hand, an allegorical depiction of what he saw as two key elements to economic prosperity: self-interest, which motivates economic activity, and competition, which organically regulates that economic activity. It was the invisible hand and its inherent argument for minimal government interference that became core to the Western-style capitalism that fueled the Industrial Revolution of the 1800s, the post-war economic boom of the 1950s and 60s, and even the greed is good era of the 1970s and 80s. And that brings us to our question of the day. In an eerie coincidence, Smith shares a birthday with John Maynard Keynes, the English economist who spent most of his career picking apart Smith's legacy. Keynes particularly saw the concept of free markets acting on their own as fallacy, advocating for greater government intervention in the economy, the invisible hand being a lot more visible and deliberate. A broader reading of Smith's work, though, shows he wouldn't have completely disagreed. While Wealth of Nations may be Smith's magnum opus, the book he published 17 years earlier, called The Theory of Moral Sentiments, is way more illuminating. Remember, Smith was by training a moralist and by profession a philosopher. Nobel laureate Michael Spence summed it up best when he told Bloomberg back in 2012 that Smith is rightly revered for fully understanding how markets and prices with locally self-interested decisions solve a massive coordination problem. But he also saw, and others later forgot, the complementary pieces, including values like honesty and regulation.
That is history being ironic when you have Keynes and Smith sharing a birthday, albeit decades, hundreds of years apart. All right, let's move on to economics, but in North America. And let's talk about the Bank of Canada. It cut interest rates today, making it the first group of 7 central bank to kick off an easing cycle this year. Here is Bank of Canada Governor Tiff Macklem earlier.
Our judgment today is that the Canadian economy doesn't need monetary policy as restrictive as it has been, and so we cut the policy rate by 25 basis points. There are limits to how far we can diverge from the United States, but we're not close to those limits.
Joining us now is Stuart Paul of Bloomberg Economics. So, Stuart, what exactly did the Bank of Canada see that the Fed still hasn't found here in the U.S. that prompted the BOC to begin cutting rates while the Fed is very much still on hold?
In Canada, they had a Q1 that was filled with downside surprises in inflation, and we had exactly the opposite here in the United States. In fact, we had some really promising data to end Q4 in the U.S., but then inflation and the disinflation progress that we had seen basically stalled out. And we're expecting to see more of that stalling on an annualized basis, on an annual basis, when we get CPI next week. Canada, on the other hand, has continued to see progress on the inflation front, and the scope of their disinflation has been improving. The scope of their disinflation has been widening, with more categories, more spending categories experiencing, in fact, outright deflation. And that was enough to prompt the Bank of Canada to start cutting rates.
So no concerns here that this would disrupt that disinflationary cycle?
I think that there should be some concerns around the disinflation process starting to reverse. One of the things that the Bank of Canada is trying to get out in front of is resetting mortgage rates, as mortgage rates reset in Canada, with about 75% of mortgages resetting by 2026.
And they're primarily on a floating rate system relative to here in the U.S., where most people are on a fixed rate.
That's right.
Yeah.
So they typically have 25-year amortization with rates resetting every 5 years.
Yeah.
And to get out in front of that and to prevent a consumption crunch and a real reining in of spending, the Bank of Canada looked to start reducing mortgage rates, reducing policy rates, and that's going to have the secondary effect of reinvigorating home prices while they're in the midst of a housing crisis, just a dramatic shortage in housing given their 3.5% annual population growth.
All right, Stuart Paul of Bloomberg Economics, a closer look at the rate decision by the Bank of Canada, a cut here. Remember, when we started in that whole rate hiking cycle, the Bank of Canada was out front. But of course, the two biggest banks in the world still have to have a say. We're going to get that say from one of them tomorrow, with the European Central Bank expected to cut its deposit rate by 25 basis points. That would be the first cut that we've seen out of the ECB going back to 2019. Holger Schmieding joining us right now, chief economist over at Berenberg. And Holger, we'll get right to it here. The expectation is for a rate cut. You stand by that? You think we're going to get it?
Well, yes, almost certainly. The European Central Bank has de facto pre-announced a rate cut. If they don't deliver tomorrow, that would be a major, major upset. That would be probably one of the biggest communication disasters in recent central banking history. So, yes, there will be a 25 basis point rate cut tomorrow.
25 basis points in and of itself is probably more symbolic than anything else, Holger. When you talk about the communication that we're going to get out of the ECB tomorrow here, do you think they will telegraph that more rate cuts are coming?
They will likely indicate that more rate cuts will probably come, but they will not be very definitive on that. And they will probably not point to the next move at the next meeting in July already, but leave it open. On balance, recently, the economic data have been marginally better than expected, whereas inflation has been slightly more sticky than expected, which argues for the ECB to be somewhat slow. So we expect the next move in rates thereafter in September, but not yet back-to-back in July.
Okay, so not yet back-to-back. So this doesn't necessarily signal the start of a easing cycle. It'll be very much kind of wait and see and depend on the data. Is that right?
Yes, of course, the ECB will once again say we are data dependent. Having said that, we will likely see later this year further progress on inflation. Mind you, in Europe, inflation has been to a significant extent the reflection of energy prices.
Right.
And energy prices on wholesale markets for gas and electricity have fallen, so that consumers over time will be able to take advantage of that. That will probably see to it that inflation in the Eurozone can fall to around 2% by the end of the year, whereas in the US it will remain more sticky. And that's the key reason why the ECB slowly but probably will cut rates and continue to cut rates before the Fed.
Now, of course, the European Central Bank is a single mandate central bank, focusing only on fighting inflation. It doesn't concern itself with maximum employment. It's also directly owned by European Union law, and it covers 27 central banks within the European Union. So what would a rate cut mean for different national economies? Which country stands to benefit the most? Which country does this not benefit so as much?
Well, the rate cut, first of all, will benefit all countries. Of course, rate cuts will have a slightly bigger impact in Southern Europe, in the somewhat more indebted countries. It will have a bigger impact on countries where the housing market is a major issue, such as the Netherlands, for instance. But by and large, this is a move that will help everybody, but only a little. The major points about the economic outlook for the Eurozone are what does happen to world trade, and when do consumers start spending their gains in the real purchasing power, which they are already seeing. At the margin, the prospect of this rate cut and then some further rate cuts to come may be one element to give consumers an incentive. Okay, life isn't too bad. Let's spend a bit of money.
When we talk about the Eurozone here, Holger, I mean, we have to sort of break apart some of the nations because they're not all performing sort of at the same sort of level, the same sort of speed, if you will. And I'm wondering, does that matter at all, particularly when it comes to making monetary policy?
It, of course, always matters a bit, but all in all, the ECB is looking and has to look at the average, at the aggregate of the Eurozone. Yes, Germany is slower, significantly slower than, say, Greece, but this is the opposite of what was the case, say, 10 years ago. You'll always have some countries doing better, some countries doing less well. On average, the Eurozone is doing a little better than it did last year. It's coming out of its long period of stagnation. Some parts are doing a bit better than others. But once again, all in all, for the ECB, the average matters, and the average suggests modest upswing in the Eurozone, further inflation progress on the horizon, so no need for the central bank to maintain its currently quite restrictive policy stance.
Got it. Holger, really appreciate your joining us. Holger Schmieding is chief economist over at Berenberg, giving us a preview into tomorrow's expected cut from the European Central Bank. Here in the U.S., we closed at a record high in the S&P 500. It was the first in a few days, right? But it was all-time high.
Well, yeah, I remember it was 2 weeks ago yesterday. The S&P had last
Before Memorial Day.
High. Yeah, I remember there was a lot of concerns here about whether we were just going to enter sort of this consolidation phase or whether it's going to be a drop-off. And I guess at least for today, we got the answer, up 1% on the day.
Yeah, there's no sell and may go away, and it doesn't look like we're starting off June that way either. The NASDAQ 100 and really Nvidia powering the overall equity market. Not much movement in treasuries. The two-year yield does come down a little bit. So there was a small, modest gain across the treasury curve. And as we've been talking about the Bank of Canada cutting rates, that led to weakness in the loonie. This is the close.
So after careful consideration, I have come to the difficult decision that implementing the planned congestion pricing system risks too many unintended consequences for New Yorkers at this time. For that reason, I have directed the MTA to indefinitely pause the program.
That was New York Governor Kathy Hochul abruptly halting a plan to charge motorists who are driving into Manhattan, upending an initiative that was years in the making that was finally set to kick in at the end of this month. Let's bring in now Bloomberg's Michelle Kaske, who's been reporting on this. And Kathy Hochul, the governor of New York, was a big supporter, a big proponent of this congestion plan, congestion tax, right?
That's exactly right. She's been behind this for a long time now, ever since she took over the governorship. And so this has been a very surprising move. It was a big surprise for many people in New York City today.
It was a big surprise, too, because the infrastructure for this has been pretty much rolled out. Anyone who's gone through Midtown, they've seen the toll booths put up. So there's a sunk cost already into this. So is this pretty much just a delay? This thing is still going to happen. It's just maybe a few more months later than planned?
Well, she didn't give an exact time.
Yeah.
She said it was an indefinite pause. So we don't really know how long that is. But the problem is that this was supposed to bring in some money to the transit system.
Did she explain, though, the offset of that whatever they lose in revenue, what are they gaining?
She didn't say exactly what the alternative plan would be, but she did say her administration now is exploring and looking into other types of revenue that they could use instead of the congestion pricing revenue, which they're not going to get now.
So it's supposed to bring in $1 billion a year to modernize the ancient, creaky subway system, and that's going to be put on hold right now. And in terms of what it does in the meantime. There's talk about maybe, I don't know, taxing businesses, but that's not something that's going to happen anytime soon either, right?
Correct. If I remember correctly, the legislature is only in session for a couple more days. And Holger did mention that this is something she'll be working on over the next few months. But the MTA needs this money now.
Yeah. And needed it yesterday.
Yes.
All right, Michelle Kaske there. A closer look at the decision by New York Governor Kathy Hochul to put on pause New York City's decision to implement congestion pricing here in Manhattan. And I've seen these things. I mean, we have one not far from Bloomberg World Headquarters here, those big toll booths. And I just think about how much it costs to build these things. Now they're just basically saying, well, at some point we may turn them on, at some point we may not.
Yeah, absolutely. And every time it rains, remember, you've seen the videos on like social media where the subway stations are flooded, the platforms are flooded because the infrastructure is old and crumbling and needs to be updated or needs to be fixed first before it can be updated. Yeah,
there's definitely a balance here, and it kind of makes you wonder if this is truly indeed an election issue. Maybe she did find some electoral currency here in putting this on pause, but it gets to the broader question here. We are heading towards a big election here in the U.S. in November, and the increased polarization and unprecedented events has some company heads dreading what is in store here in November 2024. New data from the Conference Board and SEPTO finds that most executives find that the political climate is creating more hostility in the workplace compared to the last general election cycle. Joining us right now is the global head of public policy and the head of U.S. government affairs over at Invesco, Andy Blocker, joining us here in New York. Thanks for being here, Andy, and I'm glad you didn't have to pay a toll to get here to the office today. That could change, but I was kind of interested in this survey, the CEO survey, and how many people really seem to be worried about this election. We always talk about this idea that ultimately elections don't have a huge impact on markets and even on companies themselves. That seems to be different. The feeling right now seems to be much different, that the impact of this, no matter who wins, could be pretty dramatic.
So yes, I think you're absolutely right, Romaine. When it comes to the markets, not as much of an impact on a macro basis, maybe on a sectoral basis, but when it comes down to employees who are from different points of view and making sure they get along in the workforce, that's becoming a bigger deal because even with this verdict that we just saw, it was the ultimate Rorschach test.
Yeah.
And you see, part of America thinks it's rigged justice system, and part of them thinks it was finally justice being done. And sometimes it's hard to merge those two.
I am curious, though, is this even an election cycle that we can call a cycle? And I say that because I feel in the past there really was a debate about who people were going to vote for. This seems like one of those elections where everybody's made up their mind. There's not a lot of gray areas. I don't know how many independents out there. I don't know who these independents are. Maybe they're still stuck in traffic somewhere. But it seems like anyone you talk to, either they've decided on Trump or they've decided on Biden. Is there a middle ground here?
Well, there's about 18% of the population who won't tell you how they're going to vote. They may have an indication.
Yeah.
So technically there is a middle there. But no, I think there's hardened positions. It's almost as if it's a religious fervor as opposed to an actual election.
Yeah, I could totally see that. And people belong to a certain tribe and, they can't kind of see the other tribe's point of view. For so long, the thinking in financial markets was we like gridlock. We like it when the White House is a different party than Congress and, nothing will change. We're probably going to get a divided government once again, but is that going to be good or bad in 2024 if you have so much division yet a divided government?
So I think more precisely, yes, gridlock can be good, but it's more about just having less volatility and less movement. When you have divided government, there are structures around how far left or how far right you can move and what you can get done. They're within a tighter band. So the bid-ask spread is much tighter. So markets can work in that. There's predictability. But when you have all one government, they're going to pass major legislation one way or the other.
And the other thing that that survey that Romaine referenced was really interesting that caught my eye is this idea that because Congress can't do anything on their own, a lot of the companies have kind of given up on lobbying Congress. They're finding that they can be much more influential at a local level, state level, at the town level. How much can they really enact when it comes to a state or a municipality?
No, the states have a major impact. In fact, historically, states have driven the federal government to do things later. Now they're just doing it instead. If you have a state like Texas or a state like California, which drives such a high percentage of our economy, they can have an impact on what different companies do. So yes, there is a lot of investment in states vis-a-vis the federal government.
What are like the real issues in this election? I mean, we talk about sort of the religious fervor and the idea that people have already staked their ground, but let's focus on those folks that maybe could be swayed to one side or the other. What is most important? I mean, because we always, at least on this program, it's always about the economy. But then I talk to folks like you and they say the economy isn't as much of a determinant as it was in the past.
Correct. Now, it's always the first thing, right? And today, the economy is inflation and how people feel when they go to the grocery store. But if that issue is not top of shelf for the individual voter, then you get those secondary issues. Then you get things like immigration on the border, what's going on there, crime in your neighborhood. Then you get to
congestion pricing.
Congestion pricing, exactly. But then this year, abortion's a huge issue. And so it's going to be individually driven. Where you are, where you stand is where you sit.
Is the delay of congestion pricing in New York going to make a difference, do you think? In the national elections in November?
Not really. Actually, it's kind of divorced from the rest of the country. I mean, Texas is not going to look at what New York's doing, or Michigan's not going to look at it either.
Yeah, and that gets to a broader question, though, too, when we talk about the policies, right? There's, that survey, part of the fear is that this is one of those eras where, depending on who gets elected, you could actually see a material change in policy, much more so than what we've seen in the past here. If that is true, if that does prove to be true here, is that necessarily going to be bad? Or, I mean, and I say that meaning it just kind of shifts maybe the power balance from one side to another, but it doesn't necessarily change the overall complexion, or am I wrong?
So, like I said before, on a macro basis, no, but in certain sectors it can. But even when it is, I'll give you an example.
Okay.
It's very counterintuitive. So even though there were major pro-fossil fuel policies by Trump and major clean energy policies by Biden, if you look at those fossil fuel stocks, they did much better under Biden than they did under Trump. Why? COVID and the Russia-Ukraine war. So there's externalities, there's all these other things you have to consider. So, we're here, and so that's why you need to, don't do this at home. Talk to your financial advisor, talk to us, and we can help you kind of navigate it.
All right, we'll definitely talk to Andy Blocker there. Of course, leads the government coverage there over at Invesco. As we count you down, we're done counting down.
We're done.
I'm a little
we're
confused
done.
here. We're almost done with the show, Scarlet Fu, and you know what that means. It's time for your favorite segment on the show. It's where we set everyone up for what to watch over the next 24 hours. Stick with us. I think this is Bloomberg.
This is the close, at least.
All right, here's what to keep an eye on over the next 24 hours. It could move the markets. An ECB rate decision tomorrow morning, Scarlett.
Yeah, this is the first one in, 5 years, and the ECB moving ahead of the Federal Reserve, and we'll see what it means in terms of the future cadence of rate cuts, but this is a big one, certainly for the euro.
Let's stay in Europe here. We are going to see EU elections all day long, and President Joe Biden of the U.S. will also be in Europe, in France specifically here, for that D-Day anniversary.
The 80th anniversary of D-Day, and maybe time to watch Saving Private Ryan tonight.
Yeah, absolutely here. And back here in the U.S., we're going to hear from Janet Yellen. She's actually scheduled to give a keynote speech at an AI and financial stability conference.
Yeah, it'll be interesting to see what she says and whether she comments on Nvidia reaching $3 trillion in market cap.
More earnings tomorrow as well. J.M. Smucker before the bell, Vail, Resorts, DocuSign, and Rent the One Way after the bell. Scarlett and I will be back for all your full market coverage right here on The Close on Bloomberg.